There is a reason the rich keep getting richer. And look, it's not just about working harder, it's about thinking differently. And today, I'm gonna show you the two economic principles the ultra wealthy live by that most people completely misunderstand: opportunity cost and sunk cost. If you master these two concepts and begin applying them, you'll start making smarter decisions in business, in investing, and in life. So let's start off with opportunity cost. Every single decision you make has a cost. There was a cost of the next best alternative that you gave up when you arrived at that decision. So it's not just what you choose, it's what you sacrifice by not choosing something else. Let's assume for a second you think your time is worth $200 an hour. And you decide to mow your lawn, which, you probably could have paid someone $50 and it may have taken them an hour to do that. Well, your opportunity cost is the amount you lost out on. The $200 that your time is worth, minus the $50 you could have paid someone else. The cost of you mowing your lawn was the difference, $150 of lost opportunity for you, because you could have done something more efficient with your time. If you buy a new car, you may forego the opportunity to buy a vacation home. If you buy a stock that grows slow and steady, you're foregoing the opportunity to buy a high growth stock. In over 10 years, the difference in where that higher growth stock could have gone to where that slow and steady stock gets you to, that could be a huge opportunity cost. So we really have to focus on what you are giving up when you make a decision and the cost of that decision. Now, sunk cost refers to money, time, or resources that you've already spent and that you can't get back. The key is that sunk costs should never, ever be taken into consideration for future decisions. They should never impact future decisions. They're gone. What matters is what's best moving forward. So the key is that you're not supposed to consider it for future decisions. And if we break that down in a layman's terms, what's the old saying? Don't throw good money at bad. Well, that's exactly what we're talking about here. And I'll tell you, years ago when I was in college, after college, I loved playing poker with my buddies. Texas Hold'em. You might think you had a good hand, you put 1,000 chips in, and then the fourth and fifth cards that flip over, they're not the ones that you were looking for, but you feel like you were already pot committed, is what we called it in poker terms. Because you already put that 1,000 in chips in, you had to continue to play to see if you were gonna win the hand. However, not only should you not do that in poker, you should never, ever, ever do that in any other financial decision in life. Don't ever be pot committed. The ultra wealthy, they are masters of opportunity cost. So let's break it down in 3 different areas. Let's talk the economy, let's talk business, and let's talk investing. So in the economy, smart entrepreneurs constantly evaluate where to allocate capital. Let's assume you own a business. You have $1 million. Do you reinvest it to open a second location? Or do you buy an apartment complex that throws off 8% cash flow? You don't just ask, is this a good investment? You ask, is this the best use of my next dollar? That is the opportunity cost way of thinking. In running a business, big companies think this way too. Ford, for example, stopped producing sedans like the Ford Focus and Ford Fusion so they could double down on trucks and SUVs where their margins were much higher. That wasn't an emotional decision. Making sedans came with an opportunity cost that Ford didn't want to have on their books. And in investments, look, the wealthy, they don't cling to losers. If a stock's underperforming, they move the capital somewhere better, maybe into a dividend grower or a new growth opportunity. They are constantly asking, where will my money work hardest for me right now? Who cares about what the stock has done for you in the past? Maybe you made a lot of money, maybe you lost money. That doesn't matter. All you should care about is putting your resources into those stocks that can provide you with the best return from here on out. Now let's talk about the sunk cost trap and why most people, even governments, fall for it. We'll start with the economy. So governments constantly dump billions of dollars into projects that are wildly over budget and maybe even wildly unsuccessful. Let's take California's high-speed rail project. It is years behind schedule, billions over budget, but politicians keep funding it. Why? Because they've already spent so much, they feel like they have to keep going. That is sunk cost fallacy, and it's devastating financially. Another reason is they probably don't want to admit they made a mistake. Look, when it comes to sunk costs, we all make mistakes. We all invest in projects or investments that were not the right use of our dollars. The best thing to do is to admit when you're wrong and live to fight another day. In business owners fall into this trap too. They refuse to shut down a failing division or a product line because we've invested too much already. But look, smart business owners, wealthy business owners, they know when to cut their losses and reallocate their resources. And sometimes your biggest win might be knowing when to take a loss. And in investments, the average investor holds on to losing stocks way too long because they don't want to lose money. But the wealthy, if the investment thesis is broken, they sell, they're done. They recognize the money is already lost and they move on to a better opportunity. Remember, the sunk cost is gone. Do not throw good money after bad. That is how portfolios die. If you're liking this video, make sure you like it, you hit the subscribe button, and you hit the notification bell so you can be alerted of all of our upcoming content. So look, why do most people ignore opportunity cost and fall into sunk cost traps? Well, emotions definitely cloud judgment. Fear, pride, ego, they make it hard to admit that better opportunities exist and that you may have made a bad decision. Another one is short-term thinking. Oftentimes it dominates. People worry about looking like a failure, looking like a loser, instead of just maximizing future outcomes. And I'll tell you, a lot of the biggest winners out there have experienced loss. You look at any great professional athlete, any great business owner, any great CEO, they've all made decisions that haven't gone their way. And sometimes the best thing you can do is just admit you were wrong, and that way you can make the best decision for moving forward. Now, the thing that differentiates the wealthy here is that the wealthy are ruthlessly logical. They don't make decisions to protect their ego. They make decisions to protect and grow their wealth. So how can you start thinking like the ultra wealthy today? Every time you make a financial or business decision, ask yourself two questions. What is the best use of my next dollar or my next hour? That's opportunity cost. And number two, am I making this decision because it's the best move forward or because of what I've already spent? That is sunk cost. And here's a quick weekly exercise that you should do. Just pick one decision you're facing every single week and consciously evaluate it using both opportunity cost and sunk cost analysis. Now, over time, this is going to reprogram your financial brain so that you start thinking like the wealthy do. The bottom line, master these two principles and you will start playing the wealth game the same way the ultra rich do. If you've enjoyed this breakdown, subscribe to the channel for more no spin, no fluff, straightforward financial strategies. And tell me in the comments, have you ever caught yourself falling into a sunk cost trap? I'd love to hear your story.